2026 is bringing some big retirement rule changes, and these updates affect everything from your 401k, your Roth IRA, your HSA, how you interact with the accounts, and even how your future taxes will work. So in this video, I'm going to walk you through what's actually changing, what it means for you, and what's worth paying attention to before these rules go live. Before we get into contribution limits and strategy, we need to set the ground rules for how your income is actually going to be taxed in 2026. For tax year 2026, we still have 7 federal income tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The dollar ranges for each bracket have been adjusted for inflation, so your taxable income doesn't automatically jump into a higher bracket just because of normal cost of living changes. On top of that, the standard deduction is going up a bit in 2026 under the new law. Single and married filing separately, $16,100. Married filing jointly, $32,200, and head of household, $24,150. This matters because your taxable income is your gross income minus things like pre-tax 401k contributions, HSA contributions, and then the standard deduction. That's the number that actually falls into these brackets. I don't think a lot of people understand how our income is taxed, so let me walk you through a quick example as well as how it can be reduced. Max is a single guy with a gross income of $100,000 per year. After subtracting his standard deduction, he has a taxable income of $83,900. Since he contributed $3,000 to his HSA for the year, that drops his taxable income down to $80,900. He also contributed $20,000 to his traditional 401k, which brings his taxable income down to $60,900. Now they tax that $60,900 in 3 different layers, kind of like a wedding cake. The first $12,400 is taxed at 10%, so he pays $1,240. The next $38,000 is taxed at 12%, so he pays $4,560. The last $10,500 is taxed at 22%, so he would pay $2,310. For a total of $8,110 paid in taxes. If Max hadn't contributed to his HSA and 401k, then he would have owed around $13,000 in taxes, so he saved a little over $5,000. If you are someone who has something like a taxable brokerage account, then long-term capital gains have their own set of brackets. The 0%, 15%, and 20% rates stayed the same in 2026, but the income thresholds moved a little bit. The 0% long-term capital gains rate applies up to $49,450 of taxable income if you're single, and up to $98,900 if you are married filing jointly. So if you're doing things like tax gain harvesting, selling appreciated investments, or planning when to realize gains around early retirement, those 0% thresholds are the first numbers you want to know and keep in mind. Now let's talk about the retirement accounts most people use at work, because 2026 comes with several important updates and a few rules people consistently misunderstand. First, your personal contribution limit is increasing. For 2026, the amount you can contribute to a 401k, 403b, or 457 plan increases to $24,500. Up $1,000 from last year. This is the number that comes directly out of your paycheck. Second, your employer match does not count toward that $24,500 limit. This is the part that trips people up sometimes. For example, if the employee contribution limit is $24,500 and your employer gives you a $6,000 match, you can still personally contribute the full $24,500. In that example, you'd be able to get $30,500 into your retirement account for the year. The match does not reduce how much you're allowed to put in from your own paycheck. Where the employer match does matter is the total contribution limit, which increases to $72,000 in 2026. That total includes your contributions, your employer's match, profit sharing, and any after-tax contributions if your plan allows them. Most people never hit that number, but it's good to know it exists, especially if you are a high earner or your employer makes large profit sharing contributions. There are 2 different catch-up rules for the 401k, 403b, and 457 now. Age 50 plus gets the standard catch-up. This increases to $8,000 in 2026. So if you're 50 50 or older, you can contribute $32,500 from your own paycheck. If you have an employer match, then that amount would also be able to be added on top of this $32,500. From Secure Act 2.0, ages 60 to 63 get a higher catch-up amount, which is $11,250 in 2026. This is in addition to the $24,500 regular limit. So people in that age window can contribute $35,750. This bigger catch-up is meant to help people boost their retirement accounts in the last few years before retirement. Starting in 2026, there's a mandatory Roth catch-up contribution requirement. If you're 50 or older and earn enough to be labeled as a high earner, you cannot stash extra retirement money pre-tax anymore. You have to use after-tax Roth dollars for the catch-ups. They consider anyone to be a high earner who earns more than $150,000 in W-2 wages the previous year. There's a few things people might miss with this new rule. It uses W-2 Box 1 wages, not adjusted gross income or household income. It's a previous year income test. So if you made $151,000 in, say, 2025, then your 2026 catch-ups must be Roth if you're 50 or older. If, for whatever reason, your income dropped to $100,000 in 2026, then in 2027, your catch-up contributions don't have to be put into the Roth side of things if you don't want them to. This rule applies to 401k, 403b, and government 457 plans. And here's one messed up part of this rule that very few people realize. If your employer doesn't offer a Roth in the plan, you cannot make catch-up contributions at all. So if your plan still doesn't have Roth contributions available, it's worth reaching out to your HR to check with them to see if they can start offering them in time for this to go into effect. In case some of you missed it, the Secure Act 2.0 also introduced a new feature that allows employers to let employees take employer matches as Roth instead of pre-tax. I wanted to address this since I've heard from some people who told me that their employers still aren't allowing them to contribute their match to the Roth side of their 401k. This was put into Secure Act 2.0 to start allowing employers to implement the change, but that doesn't mean they have to. This rule is 100% optional. Employers do not have to offer it. If your employer does offer Roth matching, then you're one of the lucky ones. You can choose to have your match deposited as Roth. The match becomes taxable in that year, and Roth matches must be immediately vested, which is pretty cool. Most employers haven't adopted this yet, and some don't even realize that they can't. So this is another situation where reaching out to your HR can help. Even something as simple as sending an email that says something like, hey, does our plan support Roth employer matching? If not, hey, can you add it? Can sometimes push a company to update the plan. The worst that they can say is no and tell you to kick rocks. Now let's talk about IRAs, because these also see a few important changes in 2026. For 2026, the IRA contribution limit increases to $7,500, up from $7,000. And remember, couples each get their own individual contribution limit. So if you're both under the age of 50, he can put $7,500 into his Roth IRA, and she can put $7,500 into her Roth IRA. Contrary to what some people might think, there's no such thing as a joint Roth IRA. You each have your own separate accounts that you can contribute to. If you're 50 or older, you also get an $1,100 catch-up, which brings your total to $8,600. When I saw the catch-up contribution was increasing to $1,100, I was a little caught off guard. I had to triple check to make sure that I wasn't reading it incorrectly because it's been frozen at $1,000 for the past 20 years, which is a little insane. If you want to contribute the full amount to a Roth IRA directly, you have to stay under certain income limits. For 2026, your modified adjusted gross income needs to be below $150,000 if you are single and $242,000 if you're married filing jointly. For couples filing jointly, you can only put the full contribution amount into a Roth if your combined household income is under that $242,000. A key thing most people don't realize is that stay-at-home spouses who don't earn income are allowed to contribute to their individual IRA under the spousal IRA rules. The working spouse's income covers the non-working spouse, so the stay-at-home spouse can still contribute the full amount to their Roth IRA as long as the household modified adjusted gross income is under the limit. If they're over the limit, the spousal rule doesn't magically save you. The Roth IRA phase-out ranges have also changed. If your income falls inside the phase-out range, your contribution gets reduced. If your income is above the range, you cannot contribute directly, but the Backdoor Roth is still allowed. Here's a little pro tip. If you're someone who 100% knows that you want to contribute to a Roth IRA no matter what, but you're not sure whether you'll end up over the income limit until later in the year, then just do a Backdoor Roth anyways. This is something that I do and something I have my sisters do every single year. They're both what most of us would call super savers, and they prefer to max out the account all at once at the beginning of the year. There's usually a high likelihood they'll each be over the Roth IRA income limit by the end of the year, but they never really know until we get closer to the end of the year. So they just do a Backdoor Roth regardless. That way, it's one less thing that they have to worry about. The traditional IRA deduction rules are adjusted for 2026 as well. Whether your traditional IRA contribution is deductible depends on two things. Number one, are you or your spouse covered by a workplace retirement plan? Number two, what's your income? Here are the 2026 deduction phase-out ranges. If you are covered by a workplace plan, then if you're single and head of household, it's $81,000 to $91,000. Married, filing jointly, $129,000 to $149,000. If you are not covered but your spouse is, married filing jointly is $242,000 to $252,000. If married filing separately, $0 to $10,000. These phase-out rules matter because a non-deductible traditional IRA contribution is what sets up the Backdoor Roth. If you are above the Roth income limits but still want Roth exposure, the Backdoor Roth is usually the cleanest way to do it. So to be honest, personally, because I always want to do a Backdoor Roth, I don't really pay attention to what the rules are around a traditional IRA. I just do a Backdoor Roth and ignore it because it doesn't really matter. For most people in their 20s, 30s, 40s, and early 50s, IRAs play an equal role next to employer retirement plans like a 401k, 403b, or 457. After getting your employer match, something like a Roth IRA should usually be maxed out before putting extra money back into your employer's plan because you have full control over the investments, the fees, and the provider. And here's something I learned a few years ago. There's a lot of working professionals with a 401k, 403b, or 457 who don't even know what a Roth IRA is or that they can invest in one alongside their employer-sponsored plan. So please, spread the word to all of the people in your life. If you need it, I will have a Roth IRA playlist with a bunch of those videos linked at the top right of the screen and down in the description below. Now let's move over to HSAs, one of the best accounts in the entire tax code. And yes, these limits are going up again in 2026. For 2026, the HSA limits are $4,400 for individuals, $8,750 for families, $1,000 catch-up contribution if you're age 55 or older. If you're married and both spouses are 55 or older, only one of you can use the $1,000 catch-up inside your family HSA. To get both catch-ups, so $2,000 total, the second spouse needs a separate HSA in their own name, which is something that a lot of people don't know. The reason the HSA is such a big deal is because it's the only account that gives you pre-tax contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. And if you don't need the money for medical bills right now, you can invest and let it compound for decades. Once you reach 65, the HSA becomes even more flexible. For non-medical withdrawals, it works like a traditional IRA, so you just pay income tax when you withdraw the money. For medical expenses, it's still tax-free, and Medicare premiums, long-term care premiums, and out-of-pocket health care are also tax-free. For a lot of people trying to build wealth or working toward financial independence, the HSA ends up being one of the most powerful accounts available, which most people do not fully understand. If you want to learn how I and 9% of people are supercharging our HSAs, then watch the video I'll link at the top right of the screen and down in the description below. Now, I want to remind parents about the 529 to Roth IRA rollover rule that technically went into effect back on January 1st, 2024. I'm finding out most don't know about it, or they heard about it once and didn't fully understand it. With how unpredictable the future of education and work is going to be for today's kids, the rule is a game changer. It gives parents a way to turn college money into long-term investments for their child's future. even if they don't go to college. Here's how it works. You're now allowed to roll money from a 529 plan into a Roth IRA for the same beneficiary up to a $35,000 lifetime limit as long as 3 conditions are met. Number 1, the 529 must be opened for at least 15 years. This is the rule most people overlook. The 15-year clock doesn't start when your child is born. It starts when the account is opened, which means if you haven't opened one yet, open it as soon as possible, even if you can only afford to put, say, 25 or 50 bucks in it. That's enough to start the 15-year clock. Number 2, contributions made within the last 5 years cannot be rolled over. This prevents people from dumping money right before rolling it out into an IRA. But technically, you could dump a bunch of money in at once. It would just have to sit into the account for 5 years before you started rolling it over into a Roth IRA. Number 3, you can only roll over up to the annual Roth IRA contribution limit each year. So if the limit is $7,500 in a specific year, that's the most you can roll over for that year. And that includes any direct contributions the beneficiary makes to their Roth IRA that year. Since we all know that contribution limits increase over the years, that $7,500 will most likely be, $9,000, $10,000 by the time they would actually want to roll this 529 money into a Roth IRA. This means the rollover isn't a $35,000 lump sum. It's spread out over several years until the full amount is moved over. One really nice benefit of this rule is that there are no Roth IRA income limits for this rollover. So even if your kid grows up, gets a great job, and makes too much money to contribute directly to a Roth IRA, the rollover will still work. Before this rule, parents were terrified of overfunding a 529 plan. My sister, I was just talking to her the other day, and she's like, I didn't put any money into my daughter's 529 plan because I was like, I don't know what she's going to do for school, so I don't want to get it locked up in this sort of account. Now that fear is basically gone, because no matter what path your child chooses, whether it's college, a trade school, self-education, or entrepreneurship, the money you saved can still become a part of their long-term wealth. A 529 becomes a college fund or Roth IRA starter account, or both. This gives your child a financial advantage, something most people never get. Now that we've covered the big rule changes coming in 2026, there's one more thing I want you to do. And it's technically not a new rule, but it might be one of the most important parts of this entire video. Please check the fees inside of your 401k if you have one. A lot of people think that they're doing everything right. They're contributing consistently, getting the employer match, maybe even maxing out their account. But in the background, their money is being dragged down by high fees. And the frustrating part is that some 401ks look perfectly normal on the surface, but fall apart once you examine the actual investment options. Instead of low-cost index funds, you're handed overpriced, actively managed funds or target date funds that charge way more than they should. When that's your only option, it slows down your growth no matter how disciplined and consistent you are. Let me give you Uncle Jared's criteria for what is acceptable within a 401k. Use this as your checklist. If your plan doesn't meet this standard, I'll show you what to do next. If a fund inside your 401k charges more than 0.10%, it's a ripoff. And honestly, I think 0.10% is still too high, but that's my line in the sand. Now, it's perfectly fine if your plan includes funds that cost more than that, because actively managed funds will always exist, and those are the ones that tend to charge higher fees. But your plan should also offer the core building blocks at 0.10% or less each: an S&P 500 index fund or a total US stock index fund, an international index fund, a small cap index fund, and a low-cost bond fund. Those should be standard in a 401k. If they're missing or if they exist but cost more than 0.10%, it's worth pushing for an update. If your plan doesn't meet the Uncle Jared gold standard, then I would suggest reaching out to your HR or benefits department to ask whether they can add low-cost index fund to the plan. There's a great step-by-step guide on how to campaign for a better 401k on the Bogleheads website. It walks you through exactly what to ask for and how to make the case. Believe it or not, a lot of employers simply haven't revisited their funds lineup in many years, and they won't know that there's an issue unless someone speaks up. Nothing against those individuals, but I'd be surprised if more than 40% of them even know what the heck they're doing or understand how destructive these high fees can actually be for the employees. This is a big deal because even a small difference in fees, even something like, say, 0.30%, can easily cost you tens of thousands or even hundreds of thousands of dollars over your normal working career. Not to mention, the more fees you pay, the longer you're delaying how soon you can actually retire. It's a sick and twisted way for the system to keep you locked into working for as long as possible. So if you haven't checked your 401k fees in a while, this is a good time to take a look. I put together a free 2026 financial numbers cheat sheet that lists every major update that we covered today, plus a bunch of others that I did not have time to mention in this video. It's a simple 1 or 2 page PDF that you can save to your phone or computer so you don't have to go digging for all of this stuff that we talked about every single time you need it. The link is down in the description if you want to grab it. Earlier, I mentioned how the capital gains tax brackets have changed for a taxable brokerage account. This might be one of the most underrated and misunderstood accounts out there, because if you know what you are doing, you could potentially withdraw money and pay 0 taxes on it. I show you how to do that and uncover a bunch of other benefits in this video to your left. Hit that like button before you go and check out the personal finance bundle down in the description to access all of the spreadsheets that I personally use. I'll see you in the next one, friends. Done.